Investing in stocks is an effective means of building wealth and financial security. But with all of the complexities involved in taxes when you invest in stocks, it's important to understand how you may pay more or less tax. Well, today, luckily for you, Fortune Fastlaner, we are going to give you a short and basic overview of stock taxes that are often confusing for many people. We are going over to discuss the most frequently asked questions about stock taxes. So sit back and watch this video till the end, and from there you will get a lot of insights. Don't forget to subscribe to the Fortune Fastlane YouTube channel. Before anything else, we want to give you a disclaimer. Whether investing in stocks is right for you or not, keep these things in mind. This is not financial advice and we're not financial advisors. Therefore, please be careful. Do your own research and make your own decisions on whether or not it's worth investing in stocks. This is a viable option for you. We will not be liable for any losses you may cause after investing and trading in the stock market. Before investing, we always recommended that you verify with a licensed professional person. Question number 1. What tax do you pay on stocks? If you are investing in the stock market, your investments might be taxed at different rates depending on how they were obtained. With several different rates and brackets, short-term capital gains may be taxed at your ordinary income tax rate, which is based on your tax bracket. Long-term capital gains have their own brackets, which are lower tax rates. Question number 2. How does selling a stock actually happen? You have 3 types of orders when it comes to putting up an offer on your shares: market order, limit order, and stop order. Selling a stock is almost like buying it. You can set up a market order, which is used to buy the maximum number of shares your account has in a single order at the best available price. You can also set up a limit order, which uses a custom price point and is executed once the desired or target level was received and freezes whatever the number of shares you're willing to sell. A stop order lets you sell as soon as this share falls between what you want and is immediately stopped once the share meets or exceeds your desired or target level. And stop limit orders allow you to set prices and set your order if it goes above or below the specified price points. Question number 3. Will you pay taxes on stocks if you don't sell your stock? The answer is no. It's not taxable. If you don't sell your stock, the value will increase, and that is called an unrealized gain. That means you're not subject to tax. But if you do sell your stock, it will be considered a realized gain. A realized gain is when you sell a stock for more than you bought it, and that means you are going to have tax consequences when the stock goes up in value. You are then subject to tax and pay taxes on realized gains. This can happen if you just bought the stock and it increased in value when the year ends. That increase is not taxable because it is deemed unrealized until all potential gain becomes realized. Question number 4. If you sold your stocks gain and left them in the brokerage accounts, will you be required to pay taxes? The answer is yes. While the tax law of stock that you sold changes constantly, it is still the case that you will be subject to pay tax even when you did not withdraw it and just left it in your brokerage account. If you sold the stock for a gain and left the money in your brokerage account, in this case, even though you did not withdraw that money from your brokerage account to your bank account, you have still made gains on the transactions. You will make gains while selling stocks. That means when selling stocks, you will have taxes assessed when closing the position. The answer is in part entwined with question number 1. You are going to pay taxes on any realized gain. The rest depends on what you do with the money after. That's not going to have an effect on the tax situation. Question number 5. How much do you pay in taxes on your stock gains? When you sell a stock, bond, or some other capital assets for more than its original purchase price, the result is a capital gain. Capital gains are income that you make after selling something that originally cost less than its current value. This kind of income is taxable differently depending on whether you are selling and what type of asset you are selling. This is difficult to state without getting into the specifics of your situation. Stock taxes vary depending on how long you are holding stock before selling it. Stock taxes depend on on whether you're a short or long-term investor. Short-term capital gains that come from investments less than 1 year, or if you buy stock and sell it within a year, you would be taxed on of your gains as short-term capital gains, which are going to be your regular tax rates. If you buy the stock and hold on to it for more than a year, you will be subject to long-term capital gains and you will be taxed. Be sure to figure out all the tax consequences of your stock purchase before making any decisions. As for stocks, long-term capital gains are much more favorable than short-term capital gains. When you buy and sell stocks, it just depends on how long you hold the stock. There are benefits for holding stock for a certain period of time, which dictate the tax rates that you will be paying on your gains. That's on you to decide. You may be subject to taxes, including capital gains tax rates, if you buy and sell stocks under a year. If you hold the stock for a year or longer and then sell it, your gain will be taxed at a lower capital gains rate. Question number 6. What happens if you sold your stock for a loss? If you sell stock that goes down in value and this turns your investment into a loss. Having loss on stocks in your portfolio is unfortunate. On the other hand, just because you made a loss on shares does not mean you should ignore your losses. This will be useful because the losses are considered to be deductions. For tax purposes, losses are useful. In fact, it will help you to lower your taxable income. Keep in mind, you don't want to ignore your stock losses because they are most important in terms of tax deductions. It's always important to keep track of your capital gains and losses because they could impact your taxes. Question number 7. How do you reflect all this buying and selling of stocks on your tax return? Tax declarations are necessary when you have any type of trading in a brokerage account. On your brokerage account, you will manage stocks, profits, or losses from expected trades. You will be given a Form 1099-B by your broker on the details of stock trades and taxes. The IRS Form 1099-B is a tax form that shows records of the gains and losses from your financial dealings during a tax year. Many people rely on their accountants to prepare the 1099-B form for them. If you have an accountant, you just provide your accountants with the 1099-B tax form. All the information about your investments is reduced to a simple tax summary by that person for you. This can help simplify your accounting process and make sure you're doing it right. Question number 8. How can you avoid paying taxes on stocks? It's not easy avoiding taxes, and it's unlawful to avoid paying taxes when you have legitimate taxable income. However, in many ways, there are some great strategies that help you minimize the tax burden on your investment. Some of the best strategies for you should include holding your stock longer, investing through a retirement fund instead of paying taxes up front, and using gains to offset losses. Allowing your financial advisor to help find a plan that works for you will make everything easier. Final thoughts. If you own stocks, mutual funds, or other investments, remember that all tax rules vary depending on the circumstance. It can sometimes become difficult to manage, especially when it has to do with taxes. Each investment and all taxes associated with it should be reviewed. It's equally important as an investor to understand how long you plan on holding your investments, what types of return you want, and anything else related to managing to invest. Investing is an opportunity to put your money to work, possibly even accrue profits. Before investing, remember that it's important to understand the type of investment you are making and its tax implications. Tax laws vary by country, so managing gain differentials with tax filing is essential if your goal is long-term growth and value. Are these questions in this video helpful to you? Let us know your thoughts in the comment section below. That's it for this video, Fortune Fast Laner. Remember to subscribe to our channel, and if you feel like we've delivered value, please share this video with one person. That's right, just one person, as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you'll start to see results. See you soon.